If you receive Social Security, the 2026 COLA announcement changes everything you thought you knew. The number the government just projected is not what most retirees expected to see this year. What I am about to walk you through could mean hundreds of dollars gained or lost depending on your next move. Sit down, grab your coffee, and give me the next 22 minutes, because this one matters. Right now, millions of seniors are hearing whispers about a smaller cost of living adjustment heading into 2026. Some folks are panicking, others are shrugging it off, and both reactions could be costly mistakes. The truth lives somewhere between the headlines, and I have spent decades helping people like you find it. Today, I am going to show you exactly what this COLA number means for your specific monthly check. There is a hidden strategy buried inside the 2026 COLA rules that almost nobody is talking about yet. It involves how your Medicare premiums, your tax bracket, and your benefit amount interact in a very specific way. If you understand this one thing, you could protect yourself from losing purchasing power in retirement. I have helped hundreds of clients navigate this exact situation, and now I am sharing it with you for free. Let me give you the big picture first, so nothing I say later catches you off guard. The Social Security Administration uses something called the Consumer Price Index for Urban Wage Earners, or CPI-W, to calculate your COLA. They compare the third quarter CPI-W average of the current year to the same period of the previous year. That percentage change becomes the COLA applied to your benefit the following January. For 2025, the COLA was 2.5%, which gave the average retiree roughly $49 more per month according to SSA. Before that, in 2024, the COLA was 3.2%, and in 2023, it was a massive 8.7%. Those big jumps were fueled by inflation that hit grocery stores, gas pumps, and medical offices especially hard. Now inflation is cooling, and early estimates for the 2026 COLA are hovering between 2.0 and 2.5%. Think of it this way. If your monthly Social Security benefit is currently $1,927, which is the 2025 average according to SSA, a 2.2% COLA would add about $42 per month. During those years, Social Security recipients got no raise at all, while everyday expenses kept climbing. A 2.2% adjustment is certainly better than nothing, but it can feel paper-thin when prescription costs jump. The key question is not just how big the COLA is, but how much of it you actually get to keep. The reason this matters so urgently right now is timing. The Social Security Administration will announce the official 2026 COLA in October 2025, based on summer inflation data. That gives you a narrow window right now to make adjustments to your withholding, your Medicare plan, and your budget. If you wait until December to react, you will have already missed several important deadlines that I will cover later. Let us dig into the first major insight that most seniors completely overlook: how the COLA percentage translates to real dollars at different benefit levels. If you are collecting $200 per month, a 2.2% COLA adds roughly $26 per month, or $312 per year. If you are collecting $2,000 per month, you are looking at about $45 more per month or $528 per year. And if you are at the maximum benefit of $4, no $1 in 2025, your increase would be approximately $88 per month, or $156 annually. Those numbers look straightforward, but here is where it gets tricky. Your COLA increase is applied to your gross benefit amount before Medicare Part B premiums are deducted. In 2025, the standard Medicare Part B premium is $185 per month according to CMS. Well, if that premium rises even modestly to $190 or $195 month starting January 2026. But if her Part B premium increases by $10 per month, her actual net increase is only $30. Now imagine Margaret also pays for a Medicare Part D prescription drug plan that goes up by $8 per month. Her real take-home increase from the COLA is now just $22 per month, or $264 per year. That is barely enough to cover one extra trip to the grocery store each month at today's prices. This is exactly why I tell people the COLA number alone does not tell the full story. There is another layer that many seniors miss entirely, and it involves federal income taxes on your benefits. If your combined income exceeds $25 as a single filer, up to 50% of your Social Security may be taxable. If it exceeds $34,000 as a single filer, up to 85% of your benefits could be taxed. A COLA increase, even a small one, can push you over one of those thresholds. Here is what that looks like in practice for someone right on the edge. Tom is single, age 70, with $24,500 in combined income including half of his Social Security benefit. His 2026 COLA raise pushes his combined income to $25,100, just barely crossing the $25 cell. Suddenly, 50% of his Social Security benefit becomes subject to federal income tax for the first time. Tom did not change his lifestyle, did not earn more money, and did not withdraw extra from his retirement accounts. Yet the government's own cost of living raise triggered a new tax obligation that could cost him hundreds of dollars. This is not hypothetical. It happens to thousands of seniors every single year when COLA adjustments creep upward. The IRS thresholds for Social Security taxation have not changed since 1993, which means inflation slowly drags more retirees into the tax net. For married couples filing jointly, the thresholds are $32,000 and $44,000 according to IRS Publication 915. If you and your spouse have combined income near either of those numbers, pay close attention to your 2026 COLA. Even a modest increase of $40 or $50 per month could flip your tax situation. Planning ahead by adjusting your IRS Form W-4V withholding can prevent an ugly surprise in April 2027. Let us talk about the CPI-W data itself, because understanding how the COLA is calculated gives you power. The Bureau of Labor Statistics releases CPI-W data monthly, and you can find it at bel.gov. The months that matter most for your 2026 COLA are July, August, and September of 2025. The average of those 3 months is compared to the same average from 2024 to determine the percentage. As of the most recent data available, inflation has been running below 3% annually. Energy prices have stabilized. Food inflation is cooling though still elevated, and housing costs remain stubbornly high. If this trend holds through September, a COLA somewhere in the 2.0 to 2.5% range is most likely. Some analysts at the Senior Citizens League have estimated it could land right around 2.2%, but nothing is official until October. Stay with me, because what I am about to show you will surprise you about where your COLA dollars actually go. Most people assume their raise goes into their bank account, but the financial plumbing is more complicated than that. There are at least 4 deductions that can intercept your COLA increase before it reaches your checking account. Understanding each one puts you in control, and that is exactly what we are going to do right now. The first deduction is the Medicare Part B premium, which we already discussed briefly. In 2025, that standard premium is $185 per month, and CMS typically announces the 2026 amount in the fall. Over the past decade, Part B premiums have increased by an average of roughly $8 to $12 per year. If the 2026 premium rises to $193 or higher, that alone could consume 20% of a modest COLA increase. The second deduction is your Medicare Part D prescription drug premium, if you are enrolled in a standalone plan. The average Part D premium in 2025 is around $46 per month according to CMS Gov data. Plan premiums can change every year, sometimes by $5, $10, or even $15 depending on the formulary. If you are on an expensive Part D plan and do not shop during open enrollment, you could lose another slice of your raise. The third deduction many seniors forget about is voluntary federal income tax. Percentage applies to the higher amount. A bigger gross benefit means slightly more dollars withheld for taxes each month. It is not a lot, but combined with everything else, it chips away at your COLA increase. The fourth and least understood deduction involves IRMAA, the income-related monthly adjustment amount for Medicare. If your modified adjusted gross income from 2 years ago exceeded $106,000 as a single filer, you pay higher Part B and Part D premiums. The ARMA brackets are adjusted annually, but a COLA raise can indirectly affect your future ARMA calculation. High-income retirees can pay $594 or more per month for Part B alone, which dwarfs any COLA increase. Let me walk you through a realistic budget example so you can see how these 4 deductions stack up. Barbara is 66, single, collecting $100 per month in Social Security as her primary income. Her 2026 COLA at 2.2% would add roughly $46 per month to her gross benefit. Before deductions, she would expect to see $146 deposited into her bank account. But Barbara pays the standard Part B premium, which may rise from $185 to approximately $193 to approximately $193 to $48 per month at the next renewal. She has 10% federal tax withholding through her W-4V, which now applies to the higher amount. After all deductions, Barbara's actual monthly increase could be as little as $19 instead of $46. That $19 per month equals about $228 per year, which is a far cry from the $552 annual increase the headline COLA number promised. Barbara did nothing wrong. The system simply works this way by default. The seniors who fare best are those who understand these mechanics and take action before January. And that is exactly what I want to help you do today. I want to address a common myth that I hear constantly, that the COLA protects your purchasing power dollar for dollar. The CPIW measures price changes for urban wage earners, not retirees specifically. Retirees spend proportionally more on healthcare, which has historically risen faster than general inflation. This mismatch means your COLA may cover grocery increases but fall short on medical expenses. There is actually a separate index called the CPIE, which is experimental and tracks spending patterns of Americans 62 and older. Studies from the Bureau of Labor Statistics show the CPIE often runs about 0.2 to 0.3 percentage points higher than the CPIW. If Social Security used the CPIE, your 2026 raise could be closer to 2.4 or 2.5% instead of 2.2%. Legislation has been proposed in Congress to make the switch, but as of today, nothing has changed. Now here is the part most seniors never hear about, and it could save you real money in the months ahead. There are specific actions you can take right now, before the official COLA announcement, to position yourself for the best possible outcome. These are not tricks or loopholes. They are legitimate planning strategies that financial advisors use every day. The difference is that most people never hear about them unless they pay hundreds of dollars for advice. The first strategy involves reviewing your Medicare plan during the annual election period, which runs from October 15th to December 7th every year. Many seniors set their Medicare Advantage or Part D plan once and never look at it again. But plans change their premiums, co-pays, and formularies annually, and staying put could cost you hundreds of dollars. Switching to a lower-cost plan that still covers your medications could offset the premium increases that eat your COLA. Let me give you a concrete example of how powerful this one move can be. David, age 72, was paying $67 per month for his Part D plan in 2025 because he never reviewed it. During open enrollment, he used Medicare, Gov's Plan Finder tool, and found an equivalent plan for $29 per month. That single switch saved David $456 per year, which is more than his entire projected COLA increase. Think about that for a moment. One 30-minute session on the Medicare Plan Finder website saved more money than the COLA itself. David still got his COLA raise on top of those savings, effectively doubling his income boost for the year. This is the kind of move that separates seniors who thrive from those who slowly fall behind. You owe it to yourself to check every single October. The second strategy is adjusting your federal tax withholding on. Currently have taxes withheld via Form W-4V. Review whether your withholding rate still makes sense. Some seniors over-withhold all year and then get a big tax refund, which means they gave the government an interest-free loan. Others under-withhold and face a surprise tax bill in April that wipes out months of COLA gains. You can change your withholding rate at any time by submitting a new Form W-4V to the Social Security Administration. The form offers 4 withholding rates: 7%, 10%, 12%, and 22%. If you were just below the taxable income threshold and your COLA pushes you over, starting at 7% may be wise. If you are well above the threshold, running the numbers through the IRS withholding estimator at IRS.gov can tell you the right rate. The third strategy is particularly valuable for married couples where one spouse has a much higher benefit. When the higher-earning spouse passes away, the surviving spouse receives the higher of the two benefits, not both. Your COLA increases apply to each spouse's individual benefit while both are alive. Planning withdrawals from retirement accounts strategically can keep your combined income below key tax and IRMAA thresholds. For example, Robert and Linda have combined Social Security benefits of $3,800 per month in 2025. Robert receives $2,400, and Linda receives $1,400 from her own work record. A 2.2% COLA would add about $53 to Robert's check and $31 to Linda's, totaling $84 per month. But if that extra 85% pushes their combined income over $44,000, up to 85% of their benefits become taxable. By shifting $1,000 of annual income from a traditional IRA withdrawal to a Roth IRA withdrawal, they could stay below the threshold. Roth withdrawals are not counted in the combined income formula for Social Security taxation purposes. This single adjustment could save Robert and Linda over $600 in federal taxes for the year. It requires planning in advance, which is why I am telling you now instead of in January. The fourth strategy involves the Medicare savings programs, which are state-run programs that can pay your Part B premium for you. If your monthly income is below certain limits, which vary by state, you may qualify for help. The Qualified Medicare Beneficiary Program covers Part B premiums, deductibles, and coinsurance for eligible individuals. In 2025, the federal income limit for QMB is approximately $155 per month for a single individual. Here is the important connection to the COLA. A small benefit increase might still keep you under the QMB income limit. However, if you are right at the boundary, even a $40 per month COLA raise could disqualify you from the program. Losing QMB assistance could mean paying $185 or more per month in Part B premiums that were previously covered. If you are near the income limit, contact your state Medicaid office immediately to understand how the 2026 COLA affects your eligibility. The fifth strategy is one that almost nobody discusses, and it involves the Social Security earnings test for early retirees. If you claimed benefits before your full retirement age and you still work, there is an earnings limit. In 2025, the annual earnings limit is $23,400 for those under full retirement age according to SSA. Is URDN. In my mentionation where in sequen, UNG, fay dollars you earn over the limit. The COLA does not change the earnings limit directly, but it changes the benefit amount that gets withheld. Starting to be withheld, if you are close to the earnings limit and your COLA increases your gross benefit, the math shifts slightly. More importantly, the earnings limit itself typically increases each year with average wage growth. For 2026, the new earnings limit has not been announced yet, but is expected to rise to approximately $24,000. Now let me reveal the hidden gem that most seniors never claim, and it is called the Medicare Part D Extra Help Program. This program, also known as the Low-Income Subsidy, helps cover Part D premiums, deductibles, and copays for eligible beneficiaries. According to SSA.gov, approximately 2 million Medicare beneficiaries who qualify for extra help have never applied. If you qualify, you could save an average of $300 per year on prescription drugs, home, and car. Here is the critical point. Your Social Security COLA increase is counted as income for extra help eligibility purposes. If you are near the income limit, you need to verify whether the 2026 COLA raise pushes you above or keeps you safely below. To apply for extra help, you can visit SSA.gov and search for the Extra Help application. or call 1-800-772-1213. The application is straightforward and can be completed online in about 20 minutes. If you are denied, you have the right to appeal, and many initially denied applications are approved on review. Even if you think you earn too much, apply anyway because the limits are higher than most people realize. Many people who receive extra help also qualify for a Medicare savings program, and applying for one can automatically trigger the other. Your state health insurance assistance program, known as SHIP, offers free counseling to help you navigate both programs. You can find your local SHIP office by calling 1-877-839-2675 or visiting shiphelp.org. These counselors are trained volunteers who have helped millions of seniors access benefits they did not know existed. The connection to the 2026 COLA is this: every dollar of your raise that goes to prescription drug costs is a dollar you could save through extra help. If extra help covers your Part D expenses, your entire COLA increase stays in your pocket. For someone receiving a $42 per month COLA raise, that is $550 per year, that actually improves your quality of life. This is the kind of compounding benefit that makes a real difference over 5, 10, or 15 years of retirement. Now let me walk you through the specific action steps you should take in the coming weeks and months. First, log in to your My Social Security account at SSA.gov and verify your current benefit amount and deductions. If you do not have an online account, create one today because it takes about 15 minutes. This account shows your projected benefit, your payment history, and any withholding currently in place. Second, mark 3 dates on your calendar right now. October 2025 for the official COLA announcement, October 15th for Medicare open enrollment start, and December 7th for the Medicare open enrollment deadline. During that window, use the Medicare Plan Finder at Medicare.gov to compare your current plan against every available option. Also, review your IRS Form W-4V withholding rate and submit a new form to SSA if changes are needed. Finally, call 1-800-772-1213 to ask about your eligibility for extra help and Medicare savings programs. Third, pull out your most recent Social Security benefit statement and your most recent Medicare premium notices. Compare them side by side with the estimates I have shared today so you can project your 2026 net benefit. Write down 3 numbers: your gross benefit, your total deductions, and your net deposit amount. This exercise alone puts you ahead of 90% of seniors who never track these figures. Let me bring everything together for you as we wrap up this important discussion today. The 2026 Social Security COLA is projected to be around 2.2%, which adds roughly $42 per month for the average retiree. But the real number that matters is what you keep after Medicare premiums, tax withholding, and other deductions are subtracted. By taking the 5 strategies I outlined today, you can protect and even multiply the value of your COLA increase. If this video helped you understand something new about your Social Security benefits, I would appreciate it if you subscribe to this channel. I release new videos regularly that are designed specifically to help you protect your retirement income and navigate these complex systems. Next time, I will be covering a major change coming to Medicare prescription drug costs in 2026 that could save you thousands of dollars. This channel is for educational purposes only and does not constitute financial or legal advice. Always verify directly with SSA.gov or Medicare.gov